Welcome back on to another significant development. SBI is likely to invest 7,250 crore rupees in Yes Bank if the Reserve Bank goes ahead with its draft rescue plan for the crisis-hit lender. The SBI board has approved the purchase of 725 crore shares of Yes Bank at a price of 10 rupees per share. SBI shareholding will remain within 49% of paid-up capital of Yes Bank. Lata is back with us for this story. Lata, take us through what impact this could have.
Well, actually, by saying that they're going to buy 725 crore shares, SBI has given us an idea of how the total share outstanding of Yes Bank will look after the infusion. Now, if 725 crore is going to constitute 49%, what will be 100%? 100% will be around 1500 crore. That's why 49% is 725 crore. In that 1500 crore, 725 crore we know is SBI's. Another 255 crore is already issued, the current listed shares of Yes Bank. So what is left is about 1,150. Again, in that, 170 crore shares likely will go to those who are holding 81 bonds. This is if the supposed plan doing the rounds comes true. You know, there are 8,500 crore of 81 bonds. 80% will be written down, 20% will be converted into equity. So that works to about 170 crore shares. The balance 350 crore shares we assume is going to come from other private players in the Indian market. This is a story doing the rounds. We don't have confirmation, but that's what Ritu Singh has reported, and that's what we have got. Okay, so that's the word coming in on SBI, and now we have the big story. The inflation number, and it's a very positive number, 6.5% is the inflation. I'm telling you it's positive, although RBI wants to see it at 4%. 6.5% is positive because for the first time we are getting a number which is lower than our poll. Look at our poll, it is 6.8%. And we are getting an inflation number that is lower than that. It is the first sign that numbers are going to start falling rather sharply. Even on a month-on-month basis, look at the difference. It's a 100 basis point or a 1 percentage point fall in the growth number, in the inflation number. That's extremely positive. It will give the Reserve Bank enough arsenal in April or even before that to cut, because the trajectory is very clear. We have peaked off in terms of inflation. That's very important. I look forward to the food inflation number. It was about 13.5% in the month of January. We will want to see some sharp falls in the food inflation number as well. But 6.58 itself is a very good number. The January industrial growth number has also come in at 2%. That also I think is a positive, because last time we had got a minus number, and that is for December. It was a minus 0.3. So the fact that the January IIP number is coming in at 2% is also a very positive number. I'm still looking for the food inflation. Food price index is down 2.4% month on month, and therefore I would really want to see the year-on-year number as well. But the fall of 2.5% month on month is extremely important. So now you have the January IIP number, which is positive, and you have a February inflation number which is a full 1 percentage point below the January number. So growth up, inflation down, that's the best combo you can expect or you can hope for. Let me just get initial thoughts while we read the details. We've got Indranil Pan, the Chief Economist from IDFC First Bank, Sameer Narang, Chief Economist, Bank of Baroda, A. Prasanna, Chief Economist, ICICI Securities, PD, and D.K. Joshi, Chief Economist at CRISIL. Gentlemen, thank you very much for joining me. Let me start with you, Mr. Joshi. Well, 6.5% or maybe 6.6% inflation. Do you think we are going to see much more drastic cuts? What are you expecting by way of a March 31st number?
Well, I think inflation will continue to go down because all the three components, whether you look at food is coming from down from a very high base, so that's going to correct. And the second, fuel, I think the crude prices have come down very sharply, and if government passes a little bit of that to consumers, I think that will reflect in lower fuel inflation. And as far as the core inflation is concerned, I think since the coronavirus is also going to, if it spreads faster, is also going to hit the demand, you will see lower pressure on core inflation. So I think for inflation, the trajectory from here is downwards.
Okay, let me get to the others as well. Prasanna, the 6.5 or 6.58% is a pleasant surprise for you? Is it better than what you thought? And what would your fresh trajectory be?
Yeah, that's right. So we were at 686 actually. So compared to that, it's a significantly lower number. I mean, we have to get the details actually to understand what was the positive surprise. But even otherwise, I think for the second half of next fiscal year, the profile of inflation was looking much better than say even 1 month back. And a lot of it is because, of course, the correction in global crude oil prices. Also, I think anyway we have been seeing that vegetable prices have also corrected quite significantly. And then whatever growth data we have had, both in terms of quarterly GDP data and other high frequency data, it does suggest that the recovery is, I mean, we are not seeing any sharp recovery in growth even before the coronavirus fears surfaced. What we are seeing was only stabilization, some pickup from the slowdown last year, but just a stabilization and not an acceleration. So put all this together, anyway, we were becoming more comfortable with our inflation projection for the second half of next fiscal, and of course that informs our view on monetary policy also.
So what is your end number now? Okay, 1 minute. Before that, maybe you want to be apprised of the various inflation components before I get to Indranil Pan and Sameer Narang. Cereals are up 5.2%, meat and fish 10.2%, eggs 7.2%, milk 6%, oils and fats 7%, fruits and vegetables 3.96%. So that's where the sharp fall is coming. And vegetables 31%. Remember, we were running much higher, close to 50% when onions were expensive. Pulses 16%, sugar 4.2%. So overall food inflation, food along with beverages is 9.45%. But by itself, food inflation, I just give you the annual number. Food inflation is down to 13.02. Last month, I think it was 13.63. So we are seeing, the combined inflation is down to 10.8. So it's a very big fall from 13.6. The year-on-year food inflation number for the month of February is 10.8. That's a significant fall that we are seeing in food inflation numbers. I'll just give you the services inflation, which is perhaps important. Miscellaneous is down to 4.5%. So that's the overall inflation number. Indranil Pan, your thoughts, what may be, say, the June inflation number and the September inflation number now? Are we seeing it significantly falling below 4%?
I think our estimate for this month was definitely higher than the 6.5%, so there's a positive surprise over there. If I had considered my earlier estimate of a 6.9%, then it would have taken a little bit more time in terms of coming back to the 6% threshold level of the inflation targeting mechanism. But with the 6.5%, I think it would be much easier to see a sub 6 number going forward, given the fact that for the next month we see a discontinuous downward shift in terms of the oil prices, and that is not going to impact the CPI directly, but also indirectly over a period of time, because a lot of the personal items would be dependent on oil derivatives such as soaps, etc. So definitely we see a relatively comfortable scenario emerging, not only because of the vegetable prices, but also because of the damage that the current coronavirus issue and the slowdown in India would do in terms of the demand aspect, which would keep the core inflation relatively contained.
Okay. So Sameer Narang, what would you expect by way of policy?
I think we are anticipating anywhere between 25 to 40 basis points cut in the repo rate in the April policy, and there will be more measures like the one RBI has announced today. In terms of today, they have announced a measure to give dollar liquidity to the market.
Yes.
So there will be more measures to give long-term liquidity to banks to on-lend.
Okay.
So there may be some more CRR exemption that may also come.
So you're expecting something like more LTROs?
Yes, there may be more long-term LTROs to give long-term liquidity so that the banks can on-lend to the real economy.
Okay, Mr. Joshi, what are you expecting? And more importantly, the industrial growth number coming in at, okay, just for your information, core inflation number being calculated and put out by Cogensis at 4.1% versus 4.2 in January. That's very important. Core inflation is inflation that is inherent to the economy. You know, food is more volatile and fuel is dependent on external factors, whereas core inflation usually services, what do you pay for education, personal health services, doctor services, all these are the actual inflation of the country, and that's at 4.1, so that's pretty close to the Reserve Bank's mandate of keeping inflation at 4%. The fact that it is 10 basis point lower is very important. Okay, I was asking Mr. Joshi, what do you make of the growth number? The fact that you've got a 2% industrial output growth for January, and the December number has also been revised up from minus 0.3 to plus 0.1. So positive numbers, but do you think that's the end of good news? We're going to get bad news for Feb and March.
I think so, because I think January was expected to be better. I think if you look at the PMI numbers, they were also at a 7-year high, above 55. So I think there was some expectation built that there was some uptick in the manufacturing activity, and it was what we saw today was a very mild uptick. Going ahead, I think the coronavirus, I think its impact will become more prominent in the March numbers and not so much in the February numbers. Because I think the supply shortages, etc., if it continues, are going to hit more towards the second half of March. So I think clearly, I think if the discretionary spending in the economy comes down, though it will not reflect so much in industrial activity directly, but I think indirectly it will have an impact. So we see further downside to industrial production, at least in the near term, at least for 2 to 3 months.
Okay, but just for the record, I'll read out, consumer durables has done 2.5% growth. We were seeing minus numbers for such a long time, and consumer non-durables also growing at 3.8. So this is quite clearly the Rabi impact as well, and of course there is a base, no taking away from the fact that last January was not all that good. So we've got a positive reading for consumer non-durables. It was extremely painful when for the last couple of months we were getting minus even for non-durables, so that's clearly turned. Probably it's the Rabi harvest, probably it's higher food prices, which is putting a little more purchasing power in the hands of the farming community. Otherwise, it's not a very great number. It's manufacturing is up about 2%. Manufacturing is up about 3%. That's also a base effect, but that's also something which could be transient because manufacturing could take a blow by the time we come to March. Prasanna, expectations from policy?
So we expect RBI to cut by 40 basis points. I think actually there is a case for them to cut by more, but whether in the MPC there are votes for that, we're not sure. So at this point of time, 40 basis points to take the repo rate to 475. Other than that, on liquidity, per se, I mean, the system is already having so much excess liquidity, so there is no rationale to do more. But of course, in terms of incentivizing transmission, if RBI wants to do some more direct, targeted kind of liquidity operation, it could be LTRO, it could be a targeted LTRO, where a bank, depending on how much they are lending out, they're eligible to borrow that much from RBI instead of a pro rata allotment like we have now. So that could be one possibility. Of course, I think OMO option should also not be ruled out because RBI has been selling dollars, and today again they put out a dollar sell buy swap. So which means actually they are selling their forex assets. So to replenish that, they could look to buy some domestic assets. So probably, if not in April, from May onwards, the option should also be on the table.
Okay, can you just explain what did you say? Instead of LTRO, you could have what kind of offers from the Reserve Bank in terms of liquidity?
Yeah, so it's a targeted LTRO like what the ECB has done. So basically, if you choose select loan categories like SMEs and personal loans, and then you have a reference period, and in that reference period, depending on how much a bank has lent out, to that extent it can borrow. So it's not like you just pay in on a pro rata basis, you get allotment.
All right.
So if a bank grows its balance sheet in those categories, it gets to borrow. Other bank which doesn't grow, doesn't get to borrow.
All right. Well, it's clearly looking like the Reserve Bank will move in all these directions because they do want to increase credit offtake, which is standing at a very poor 6.4%. There are two bank-related economists over here, Indranil Para and Sameer Narang. Indranil, you think that this will improve credit offtake, both a potential cut in rates and, as Prasanna is saying, some incentivized liquidity provided by Reserve Bank?
Possibly no is my clear answer, simply because I think the credit demand is also, credit offtake from the financial sector is also a function of the demand in the system. With the equity markets having taken such a beating, the net wealth effect of the urban consumers is also significantly down. That should set in some negative sentiment in terms of the consumption behavior, and therefore individuals could be holding back on their consumption. So yes, the RBI might want to keep the liquidity in the system awash and sort of incentivize lending towards certain segments of the economy, but that might not immediately help in improve the credit offtake. From a more sort of wholesale perspective, I think the clear indication is that the industry per se operates at a at a low capacity utilization level of around 73%, and with the coronavirus issues it may actually go lower. So I don't think there could be much incentive for capital expenditure by the corporates. And on top of that, because of the metal prices and the oil prices having coming down, the requirements for working capital might also go down. So I'm not really hopeful of credit offtake happening immediately in the system.
Yeah, but I would still give it to the RBI if they are going to design policies like Prasanna is pointing out. Already they have been very proactive with dollars. So if they are proactive also with matching liquidity, matching provision of liquidity with loans given, that could be a very good incentive. Sameer Narang, do you think this can at least stave off MSME and SME distress if, as Prasanna says, liquidity is provided back to back with banks providing liquidity to say SMEs or MSMEs? There is also a restructuring window available. The possible or the inevitable stress that will fall on SMEs and MSMEs because of the coronavirus supply and demand disruption, do you think a wave of NPAs at least could be avoided?
I completely agree with you, Lata, on that point. Actually, there are many disruptions happening. At the same time, there is going to be a supply disruption from China, and there is a technological change. So technological change that is happening will lead to NPAs coming in the future. And even if we are doing some dispensation, so that is just going to make sure that you stave off those NPAs for a year or something. But those businesses which have been doing well and are facing supply disruptions or demand challenges because of coronavirus or discretionary demand coming off will come back. So a temporary reprieve to them will be of great help. At the same time, from 1st April, medium enterprises will also get benefit of external benchmark. And as you would know, external benchmark is anywhere between 10 to 15 basis points lower than the 1-year MCLR. And as the repo rate cut happens in April first week, you will see a faster transmission for some of those segments. So at the margin, if your EMIs are going down, it will help you to stave off financial distress for some more time and enable you to live longer. So at the margin, I think it will be definitely beneficial. And if you see the history of real estate market any which ways, you will see there have been turning points in 2003 and 9 where even once SBI did this teaser loan which was incentivized buyers to come out and book a lot of mortgages, so that helped in 2008. And 2003 a 10-year mortgage was available at 7% fixed. So these events do help in the long run in reviving demand.
Fair point. Actually, I mean, all this, of course, is in anticipation. We were just running by, when you were speaking, Sameer, all the month-on-month comparisons, and whether you take electricity or whether you take manufacturing, consumer durables, consumer non-durables, January has done so much better. Electricity, 3.1% compared to the month ago, minus 0.1%. Consumer non-durables, look at the improvement. I mean, we were running running at a minus 3.7. Now we're still running. I'm not sure, is that minus consumer non-durables for January is okay. Yeah, minus 0.3%. But it's, improvement on every quarter. There is manufacturing minus 1.2 in December, plus 1.5 in January. We were on the path to recovery. Electricity is really a sharp recovery year on year terms, and it's very unfortunate that perhaps February we will still see positive numbers, but March could be negative on many of this, because we're seeing schools shut down, we're seeing cinema halls shut down, we're going to see a big blow to travel, tourism, maybe even retails like, retail places like malls and exhibition centers. So we are going to see a recovery cut short by this very, very unfortunate intervention in terms of the coronavirus related curbs. Well, let me end this conversation by asking all of you, therefore, where do you see the current year's GDP growth and the next year's? As of now, of course, all these are moving targets. Let me start with you, Prasanna. Have you revised numbers for the current year GDP? Where does it stand now?
So we were at 5%, so we have not revised it. So actually I want to point out that actually the February numbers won't get affected. And in fact, they will get a bump because we got an extra working day in February this year compared to last year.
Fair enough.
So even some of the high frequency numbers in February are actually looking okay, including power generation. So this year's financial year's growth, I think there will be some hit in March, but we might be able to scrape by. Next year, we were already at 5.7, which is lower than the RBI's and the government's estimate. As of now, we are looking at downside risk to it. We have not kind of frozen our numbers, depending on it's a developing scenario. But definitely, yes, it's not looking good. I think there will be a significant downward revision. And we'll be doing it. We are waiting for more data basically. Once March is through, we'll be in a better position to do that.
Oh, absolutely. I mean, there is an uncertainty with respect to the virus and how long the supply and demand destruction can happen and how deep and wide it can be. At the moment, travel and tourism clearly affected. So 5 and 5.7% with a negative bias. Indranil, your numbers?
We continue to work with the 5% for this financial year. Taking some implication of the coronavirus into the next financial year, we were looking at a 5.3%.
Okay.
But it all depends on how long this actually lasts, and therefore it may actually have both an upside and a downside momentum to it.
Oh yes, we'll have to wait and see. Mr. D.K. Joshi, what are you working with in terms of growth numbers?
Well, I think we are going with 5% for this year, and for next fiscal year, which is 2021, incidentally our forecast right now is also 5.7%. We have a downward bias, and I think to that number, and we'll need to continuously evaluate the coronavirus related disruptions in the domestic economy. Because it's non-linear in nature, it's very difficult to visualize what's going to happen. So you'll have to keep reassessing the situation as the time goes by.
Oh yes, black swan, isn't it? Sameer Narang, your numbers?
We are at 4.8 for this year and 5.5% for the next year.
Okay, so those are somber numbers in terms of growth. Probably only 5% this year, and even next year not a very big jump, but hopefully next year is the time when we will get upside surprises. There is so much of negative news that probably with the coronavirus ebbing out and plentiful liquidity being available, restocking possibly globally, we could see some upward revision, but all that depends on how the coronavirus issue ends, when it ends and how much it takes in its wake. There are too many uncertainties now for people to be able to size up their growth numbers even in the next quarter. So, the whole of next year is a very long haul. Thank you very much, A. Prasanna, Indranil Pan, Sameer Narang and D.K. Joshi for joining us. The message from the macro numbers is the inflation number has clearly peaked off. It is lower than what all our experts, economists were expecting. We were expecting a 6.8 inflation number for January, but what we for February, but what we have got is a 6.5 number. So clearly inflation has peaked off. Food inflation in in particular from 13% plus has come down to 10% plus. So big fall in the inflation numbers. Growth numbers are looking very good for January compared to December, and it is possible that February also we will get good growth numbers, but that bonhomie is not being seen for March and for the coming year. With that, we wrap this special broadcast of the February retail inflation and the January industrial output numbers. Thank you very much for watching. News and updates on the other side of this break.